Hello everybody. So let's discuss what happened in fixed income markets in the third quarter of 2022 and what a tough quarter it has been. I think if you listen to my previous video in the second quarter, we said that the latter part of 2022 is going to be a very difficult year, and it's turning out that way to be. We saw that especially in fixed income markets, in the global bond markets, it's really been a period of severe upheaval. Why? Because we've got this dislocation happening between what bond markets are pricing and how hawkish central banks have become. And it's really about the Fed and the BOE and the ECB. And those big central banks are saying, look, inflation is well elevated above our target ranges. We need to be aggressive on interest rates. We've seen, especially the Fed and the ECB, more likely in Q4, that they will probably hike interest rates by around 75 basis points over the next few meetings, meaning interest rates are going to go up in all these developed markets, right? If we move it back into South Africa, we've also not been spared. We've also seen the SAR becoming a lot more aggressive, especially in the middle part of 2022, also continually hiking by 75 basis points at every MPC meeting. We can probably expect more of the same. So there's probably in Q4 at least one MPC meeting left where we believe the SAR will probably hike rates by another 75 basis points, taking the repo up to around 7%. Now, if you think that we started last year when the repo was basically 375, so that's quite a big move in a short space of time from the South African Reserve Bank. And you would say, well, if we look at what happened at global bonds, why have we had so much pain in our bond markets? Well, interest rates have been very elevated and inflation have been very elevated. We all know, we feel it in the petrol price, we feel it in our pockets with food prices. We're all taxed, right? And bond markets have to reflect that reality. So when I talked earlier in the year, I said, look, let's try and set ourselves up for 2023 because 2022 is going to be a bumpy year. As we said, inflation is high. Central banks are going to keep on hiking rates. Expect another 2 hikes at least from the Federal Reserve, another hike from the SARB, the ECB, the BOE. Lots of interest rates going up in the world. So returns cannot be high in the fixed income market for most of 2022. We're feeling a lot of pain. And if we think about the last quarter, so what have the returns been like? So cash has probably given you around 1.3% in the third quarter of 2022. Bonds have given you a paltry 60 basis points. But even worse, the actual asset class, that's inflation bonds that should protect you against inflation, has had a -1 return in the third quarter. That's painful, showing that even places of protection has had pain in 2022, but we think it will reverse in 2023. So we want to set ourselves up for a better 2023. Why? Because we think inflation has probably peaked. We've heard from the governor of the Reserve Bank that he also thinks that inflation in South Africa has probably peaked in the July number around 7.8, and now inflation will slowly trend down towards the latter part of 2022. And then we think there could actually be a big move in the early part of 2023 of inflation quite a lot lower, which means the SAR will probably take their foot off the pedal in terms of interest rate hikes. And I'm of the opinion that at some point the growth in the economies are going to slow down materially. Consumers are under pressure. And maybe in the middle part to latter part of 2023, you probably find that the SAR will have to cut rates. Even a very hawkish Fed might be forced to cut rates in the latter part of 2023. Now that will be a good sign for markets. It will be good for nominal rates, but it means that we as investors in our funds will have to go through a little bit more pain for the rest of 2022 before we'll probably have the fruits of those investments that will play out in 2023. So what are we saying? We're saying, well, look, it's usually in times of stress that you basically set yourself up for good future returns. It will be no different in South African fixed income markets. Because remember, by the time the market reprices, nobody's going to ring a bell and say, look, it's time to buy bonds. It is still a good time to buy bonds, but yes, it will only play out next year. So what are the type of returns that we can expect from fixed income over the next year? Well, I think next year inflation is probably going to be around 5.5%. Cash will probably give us 8.5%. That's very attractive, right? If you want to sit in a very conservative space. Credit is not attractive to us at the moment. It's probably a 7% return over the next year. Inflation bonds will benefit from the high inflation to extent, but that's probably a more 8% return. And then we think our favorite asset class still remains South African nominal bonds, government bonds, believe it or not. We're probably going to see about a 11 to 13% return from government bonds. Now, if inflation is 5.5, well, that's inflation plus 8 from government bonds. I mean, that's equity type returns with bond risk. And that's why we remain committed to our position in South African nominal bonds. Yes, it's going to be tough. It's going to be a bumpy ride. But remember, when we invest in bonds, it's a long-term investment. And we will bear the fruits over time. In the next 2 to 3 years, we think the bond trade will play out. But good luck out there. We know it's hard, it's tough. We feel it in our funds. We're there with you. And good luck for the rest of 2022.